I'm Lee Godbold with Jerry Digital, the marketing agency for million-dollar junk removal and dumpster rental businesses. Private equity is moving in fast on the junk removal and dumpster rental business. They're making big offers, flashing big cash, and talking about synergies. In this series, this is part of a multi-part series, we're going to be going into what is private equity, how you make money, how they make money, should you sell to private equity, what do you need to do to your business to get it to the point where it's ready for it? That way you can decide, is going the private equity route the best thing for your junk removal and dumpster rental business? So get ready as we go into the big world of massive money in the junk removal and dumpster rental business of private equity. Here we go. Okay, all you $1 million plus junk removal and dumpster rental business owners, or those that are not there yet, but you plan on getting there. Hey, this is a real exciting video series that we're about to kick off on private equity, and this is part one. So what we're going to go into this on this particular video is making sure we have a good understanding as to what private equity is. PE is something that a lot of people have heard of, and any of us that have built $1 million plus, as in $1 million plus in sales, junk removal and dumpster rental companies, most of us or many of us have been contacted by people wanting to buy our business, and oftentimes that's a private equity fund. But people really don't understand exactly what it is. They just look at, hey, I can sell this business here and I can get a check for X amount of money. But there's a lot more that goes into it. And honestly, there is a lot more opportunity with private equity than just getting a check. And that's what we're going to go into. So what exactly is private equity? Private equity is a fund that buys businesses. Now, unlike venture capital funds, private equity companies are purchasing a good business. They're purchasing a business that's already been open for a while. It's got a balance sheet and a P&L sheet that continually shows growth. It's healthy. It's got healthy profit margins. It's got a growing top line. Probably has decent people. It's got customers that are reusing it. It's a good, healthy business. Whereas a venture capital company, they are actually investing in an idea, and they're investing some money in getting a portion of the ownership of the company with the off chance, and it's an off chance, that idea is going to hit it big and they're going to make a lot of money. So on one hand, you have PE, which there's never a certain investment, but you're buying good, proven businesses. A lot of times PE makes money, and generally they've outperformed the stock market historically. And then on the other side, you've got venture capital, which is very rarely actually hits on a successful one. They have a lot of duds before they have an actual successful one. Private equity funds, what exactly are they? So where do they get their money? Generally, PE funds are getting their money from, could be very wealthy individuals, insurance companies, university endowments, other institutional investors, pension funds. That's where they're getting the money, the large amount of money for the PE. So private equity is not available for just any Joe Schmo off the street with a few $100,000 or even just a few $1 million generally. You're talking ultra wealthy individuals, ultra wealthy institutional investors, sophisticated people that are looking to invest money in and get a much higher return out than they would get from the stock market in about a 3 to 7 year period. So if a PE fund buys your business, they're going to want to sell it within 3 to 7 years. If it gets much beyond 7 years, it's probably been a dud, and they're still going to try and get rid of it just as soon as they can get their money back out of it and move on to the next thing. One way you can look at private equity is this. You can think of it partially. You can think of it like if you're flipping a house. With a house, you go and you buy a house and you make some improvements to it, you fix it up, and you make it worth more. Well, private equity fund is looking to do that, but they're buying a really strong home that doesn't need a whole lot, and they're going to sell it at a profit. But really, that's not a great example because there's so much more than that in terms of how they can get an even greater multiple than what they purchased it for. So overall, private equity companies are looking for a few things. They're looking for a company that has strong cash flow, So it needs to be profitable. They want a company that has recurring demand. This isn't some one-off service that's going to go away. Waste removal, junk removal, dumpster rental has recurring demand in markets that are doing well and in markets that are doing poorly. They just do well. People are always going to need to get rid of junk and trash. They want companies that are scalable. They want to be able to grow the top line. They want to be able to expand into new markets. They want to be able to purchase other companies and combine these companies together. They want things that can scale and grow. Oftentimes they look for markets that are fragmented. They don't want to see just one or two dominant players. There needs to be a lot of smaller companies out there, because then they see the opportunity of going and basically buying a bunch of companies, making them run better, growing the top line and gaining market share. That makes them more valuable. The junk business and the dumpster business definitely checks that. They're looking for a relatively asset-light model oftentimes. So this really pertains to junk removal. Junk removal is pretty asset-light. Yeah, you've got $90,000, $100,000 trucks, but outside of that, those trucks can make a lot of money. It's not a huge investment, nothing like investing into a big factory or something like that. Now, dumpster rental businesses are a bit more capital intensive than junk removal. However, comparatively to other types of business models, they're still pretty light on the asset side of things. So what are the ways that private equity actually invest in junk removal? One of the most common ways is one of the ways they are able to make a bunch of money is they do a leveraged buyout, or an LBO. So basically what happens is, let's say you've got a junk removal business that's doing $5 million a year top line, you're profiting $1 million. They're going to come in and offer you a certain amount of money. And let's say that $1 million business or whatever, they come in and they offer you 5x, or let's say 4x. So they come in and they offer you 4x. So 4x $1 million, so that's $1 million is your profit, or your EBITDA, your earnings before interest, taxes, and depreciation. They come in and they offer you $4 million. What they're going to do is they're going to take out debt on that deal to purchase it. So they're probably going to have to put something like 30% down. So on $4 million, they're going to need to put about $1.2 million into the deal. And then they're going to finance the remaining amount. They've got lenders that they work with that will lend the rest of the money to buy this business. And what they're going to do is, generally a lot of times, they're going to buy several businesses and they're going to start rolling up these companies into a larger fund by doing these LBOs. The ingenious part or thing about it is, again, they're buying good businesses. They've got historical cash flow information, and they're normally going to be able to finance this over maybe 10 years. They know what their debt service is going to be, and they know, hey, all right, the way this is, if we just maintain, or maybe even if the business gets a little worse, they'll probably put in a little bit of a buffer. We know we can make the debt service just off the earnings for this business. And they're going to look for it to be profitable. So we know that every time we buy a business, even on top of the debt that we take out, it's making us more money. Well, that's growing the pot, the dry powder that we have to go out and buy more businesses. So every time they buy another business, it starts snowballing, and they get more money and more money and more money in this particular fund. And they go out and they buy more businesses until they've rolled this thing up into a very valuable asset. So why is a roll-up important? The more top-line revenue and the more EBITDA, so the more profit that a company has, the higher multiple that the business is actually worth. So what is a typical junk removal and dumpster rental business worth? Let's go into a couple scenarios here. Let's say you've got a company earning between $200K to, we'll say, $500K. This is EBITDA, earnings before interest, taxes, depreciation. Think of this as profit. Not exactly the same, but to keep it simple, think of it as profit. So this company right here is probably, if you're 200,000, you're probably about $1 million top line. This particular business is going to be worth about 1 to 3x. So you're going to be looking at, if you're $200,000 profit, you're going to be worth somewhere between about $200,000 and $600,000. Now let's go to another range here. Let's say we've got a company that is doing between 500K and $1 million profit. This particular company is probably going to be worth something like 2x to 4x. So now this $500,000 profit company, which, you know, you're going to be about $2.5 million generally in a junk removal and dumpster rental company in sales to get a $500,000 profit. You're going to be worth somewhere in the neighborhood of about $1 million to $2 million. 1M to 2M sale. All right. If we've got a company doing $1 million to $3 million EBITDA, now we're going to start talking higher numbers here. So at this point, if we're at 1 million to 3 million, we're looking about a 4x to 6x return. And then if you're at 3 million plus EBITDA, now you're talking something like 6 to 8x. So just to give you an idea, this $3 million business right here is going to be worth something in between, if they get a 6x return on 3 million, that'd be about 18 million to 8x on 3 million would be as much as about 24 million. So you're talking sizable numbers with this once you get up into especially that 3 million plus. Now a $3 million EBITDA business is probably going to be doing between 12 to $15 million a year top line in the junk removal and dumpster rental company. That's about where Sam Schick was. Sam Schick, that is a consultant with JRA, that's where he was prior to selling his business. And you can see probably kind of what you would expect to get once you get to that kind of volume, which, you know, that Sam had reached to. So what are the different ways that you earn money out on this deal when you sell to private equity? Do you just get a check and then you're done? And I think that's what a lot of business owners assume, is they just cut a check and they're finished with it. No, that's generally not going to be the case in the private equity world. And let's run through some of the numbers on why it's really exciting that it's not necessarily the case, and because your potential returns are even higher. So let's go through a scenario here. Let's say that we have a business doing $1 million in EBITDA. And I'll just put on here, you know, $1 million business in EBITDA is probably about a $5 million top line. All right, if you got $1 million in EBITDA, let's say you get 4x. So we have 1M times 4x EBITDA equals a $4 million sale. What a private equity company is generally going to want you to do, instead of just cutting a check and you being done with it, they're likely going to want you to actually reinvest a certain percentage back into the fund, generally somewhere between about 10 to 40%. Coincidentally, oftentimes they need about 30% down on the deal. when they leverage it. So their lender's going to want 30% down. So many times they're going to ask you to put down 30%. So 30% of 4 million is you're going to put in 1.2 million into reinvested. 1.2 million reinvested. You're going to get a check. You're going to cash out at that point for $2.8 million. Now, you might be saying, why would I take that deal? I've put all this effort into building this thing up. Why am I going to leave $1.2 million into the deal? The other thing, if you're shrewd, is you're going to realize something here. Again, I mentioned they need 30% down with their lender to buy the business. Well, they're asking you to put 30% back into the deal. That 1.2 million, that's actually their down payment. So a lot of these private equity companies actually are able to structure deals where they have no money down at all. So they're not taking any of their money and actually buying the business with it. Now, a lot of times what they'll do then, you might ask, well, what do they do with the money in the fund? They'll take the money and they'll invest it into the company to help grow that top line, to help grow that bottom line, to make things more efficient. At first glance, you're like, well, essentially, I'm buying this business for them. That's what you're looking at. It's like, hey, I'm giving up all the control and all the ownership, and all they're doing is going out and they're borrowing money to buy this thing. Why do I want to buy the business for this particular fund? The answer to your question is your returns can be exponentially greater by doing this deal if you pick the right private equity partner and you guys have the right strategy. So let's go into the numbers some more. Okay. So you've got $1.2 million into this deal. Let's say the private equity company comes in and they're able to increase the EBITDA to $3 million. Now, what happens, and the way they do this, by the way, is they could buy, in additional businesses and roll it up under. They could just inject more money into marketing. They could grow into new markets. Let's say they increase this EBITDA up to $3 million. At that point, this is now worth 7x multiple. So the total sale price, 3 million times 7x, is now $21 million. You're 30%. Remember, you're a 30% owner in this now. So your 1.2 million, or your 30%, is now worth, your 1.2 million is now worth $6.3 million. So let's look at the total now, the total amount you made on this deal. Let's come in here. You have already taken out 2.8 million. You just earned 6.3 million. So now the total amount that you earned on this deal is $9.1 million. Now you see how impactful private equity money can be for a junk removal and dumpster rental company. This is how you can make money. So I went in already and I gave you some scenarios early on what a business is worth depending upon its EBITDA. And now you can see how this whole private equity thing can work if you can reinvest back into it. So what you need to do is you need to have a target. You need to say, hey, I want to sell this business, and let's say we want to sell it in 3 years. Well, if I want to sell this thing in 3 years, then this is the top line I need to get to. This is the EBITDA I need to get to be able to get this type of return. and then we will need to find the private equity companies. Now, as part of this private equity series, we will be interviewing private equity companies that have either already in or potentially have an interest in the waste removal space. This is a multi-part series, and we'll be introducing those once we get through the introductory videos here. We'll begin interviewing some of these private equity firms. That way, and we'll put together a database of them. That way, when we're not just going to open this up just to our clients too, because we have a lot of clients that are starting to think about selling. They've reached that $1 million plus mark on top line. They're not quite, we don't have anybody quite at $1 million profit yet, but we've got guys that are getting close. We've got guys that are approaching that. They're probably within about 2 years of getting to $1 million profit mark. Well, now they're saying, hey, we might want to sell this thing. So what we're doing as part of this series is we're putting information out to everybody. Everybody that is currently in business that potentially wants to sell, or you want to build something up to sell, we want to give you the information through this series to understand how private equity works, for you to determine should you sell to private equity, how much money you might be able to make, what to expect after the sale. One thing I want to make sure everybody understands is when you sell to a private equity business, you become oftentimes their employee. Very seldom are they not going to want you to stay involved for at least a year period. Oftentimes they're going to want you to stay involved longer. And if you are unable to stay involved longer, if you can't make it work, many times you're not going to earn the full amount that was agreed on. Inside the contract, there'll be an agreement that with some specifications on numbers the business needs to hit and potentially some responsibilities that you need to do for you to get your full payout. So that's one of the things you want to explore, and you really need to kind of search deep within yourself to figure out, hey, I've been a business owner for several years now. Am I capable to go and work for somebody else? There were also private equity firms with different levels of aggressiveness and different levels of being hands-on or hands-off. All of them are going to be hands-on to at least a certain degree. They've put money in, they expect to get a lot more money out within 3 to 7 years. You have to determine what's the best fit for you, because oftentimes the companies that are the most hands-on, the funds that are the most hands-on are actually the ones that are going to push you the hardest and help you the most so you can earn the most money. But they're also going to be the one that is going to have their fist all up in you. And if you're not performing, they're always going to be there pushing and pulling you along. And they're also going to be the ones that if you can't cut it, they're going to replace you with somebody else. You got to understand that's a possibility. There are other funds out there that are a little less hands-off. They're more advisory. That might fit a lot of us, but you understand you might be leaving money on the table compared to the ones that are much more hands-on. So this has been part 1 in the private equity series. If you want to get to the point where you can sell a private equity and earn some of these great big profits, we'd love to help you at Jerry Digital. We are the marketing agency for $1 million plus junk removal and dumpster rental companies. We got a lot doing that amount now. They started with nothing. They're well over $1 million plus now, been with us for several years, doing extremely well. We have a lot of big companies that come over to us that are crossing that threshold and continuing to grow. If you want to get to that point, check us out at junkready.com. We'd love to help you grow your business so you can one day make a big cash out to private equity. I am Lee Godbold with Jerry Digital, the junk removal and dumpster rental marketing agency for $1 million plus junk removal and dumpster companies and business owners and those that want to get there. Please give us a thumbs up and subscribe to this channel. We will have the next round of the private equity series coming up in just a few days. Appreciate you watching.